Are we ready?
Yeah.
Cool. Okay. So I'm just going to do a little market update first and then run through a couple indicator strategies, like some combinations of stuff that I think is really effective, and kind of go it from there. But yeah, it was felt weird. It's like the first week in like a year that I didn't do daily market update streams. So we'll see about that because I kind of missed those. That really helped me. So anyways, something interesting happened last night on the CME, which is partly, I think, why we flushed back down. We actually had a midweek gap. For the people who aren't aware of the CME, what the CME is, the Chicago Mercantile Exchange. It's institutional trading, long and short positions on Bitcoin. So it's a pretty big deal. They have the gaps when there's price gaps that form on Bitcoin on the CME. They have a very high fill rate. So if you have a weekend gap, the odds that it's going to be filled within that week are extremely high. They're usually like over 80 or 90% on average. So anyways, one of the interesting that happens last night was we actually had a midweek gap. So just like we had at the beginning on Monday, where we had, essentially closed back down and then price came back down and filled the gap right from the close to the open 2 hours later. The biggest thing that was really creepy is that we did the same thing here, which is very interesting to see it's happening in that kind of like interim after hours period. So gap form filled. This is the second time we've had that, but overall, I think I still have the image from last week. No, I do not. I got a really old one. So I'm going to pop that in real quick. Give me a second to show what we did. I'm still waiting for the new updated report. Should have been out already, but they've been really sluggish. At least it's better than it was a couple of months ago when they had some kind of data breach and we didn't get a CME report for like a month and a half. So local stuff that's interesting. So if I'm looking at time period of commitment to traders reports, it's actually, there it is. So as of the 29th, so it's a week old or over a week old, so it's not super relevant. So if you go to the 29th, essentially, you're looking at like the block between, it goes from Tuesday to Tuesday is how you get these reports, essentially. So you get them on Friday at the end of, operating hours for the most part, and then that shows from Tuesday to the previous Tuesday. So it's kind of backdated data. So the one we're looking at now is actually from the section of about the 29th of August to the 22nd. So this little block essentially right here, roundabouts. So in that area, and what we've seen previously, just to kind of go over what's going on with the CME, is that there was this very, very significant amount of asset managers' institutional longs. That's pretty typical. If you ever look at this thing and like want to see who wins all the time, most of the time it's the dealers' intermediaries. So the asset managers, institutionals, these are like your typical hedge fund type guys longing and shorting. They almost always long over short, which is what they've been doing essentially this entire up run. They've actually been doing not too bad. Conversely, the dealers, intermediaries, these are the exchanges, the brokerages, the boys, as Max calls them, right? They massive ads on shorts, and they're actually closing positions now where they close it back here in profit. So effectively, whatever the dealers, intermediaries do, that's the expectation that they're going to be right most of the time. And then leverage funds as well. There's quite a bit of short leverage that's significantly high at this point. So in any case, there is quite a bit of short leverage built. I still don't think it's time to pop yet until we essentially see the asset managers, institutionals adding more shorts. And this is kind of the first time from this period to what we saw back in the middle of August, where the asset managers, institutionals, who are usually wrong, essentially started adding shorts as the move already happened, which is, pretty typical. So what I want to see the most going into the next report we get, hopefully we get it at the end of the stream so I can update it, is I'd like to see dealers, intermediaries, them adding longs and closing more shorts. And I want to see asset managers, institutionals adding shorts and closing longs. That to me would be probably the most interesting, just because it shows like a general market shift, because these guys are usually clueless. The exchanges and brokerages, they know exactly what they're doing for the most part. So, and then overall major gaps, when people say, oh, we can't go back to 20K, it's like, we probably should. The same sense that if we actually went above to 35K, we're talking about a year-old gap that will be filled at some point. I have no doubt about it. So in any case, if we did fill the gap and actually hold the low from March, higher time frame, that would still constitute the major retracement. And if we don't hold that, if we don't hold 20K, like I hope you're ready for the teens again. And for you guys who have capital, anything sub 20 is for buying, accumulating. Even if it goes lower, even if it goes to 12, it's not too crazy of an idea. So in any case, that's the CME, just to kind of knock that out. Looking at Bitcoin as well, for the guys who don't know how I chart usually, yeah, I use a lot of indicators and stuff, but I also use swings for reversals and structure placement and whatnot. When I place like manual SRs, all I'm really doing is I'm putting my ticker on the weekly and monthly time frame, and I'm saying, oh, there's a bullish engulfing candle. Oh, there's a bearish engulfing candle. And the reason I'm doing that is to show high time frame reversals in supply and demand, essentially where buyers are in control and they reverse price, or sellers are in control and they reverse price. So where you actually see the flips, I mean, that's an important thing to see. And higher time frame as well, 26.7 locally seems to be the most important structure that I can find, because otherwise this is essentially the weekly time frame is this is low liquidity, dead, like destruction essentially, that we're closing weeklies on continuously after wicking to the lows and then wicking to the highs and even going higher and bearishly backtesting structure to come lower on high time frames. Overall, not great. We're still technically closing above the lows. The September open at 25.9. If we close Sunday out underneath that, I'm not super positive until that's regained. But even then, I'm probably targeting a larger move back down. Let me go on my high time frame levels real quick just to explain everything. So yeah, we did the lose this equals bad. That was happening back in the middle of August. We talked about that. The overall structure I kind of look at is I break everything as a range of a range, and I try to break things down into individual ranges for testing. So we've broken down below the range. The expectation is that we'd eventually tag 24.2, 24.3 on the higher time frames until we get back above important stuff. 26.7, that would constitute a range gain to potentially test higher. Yeah, and then the whole lose this equals bad 27.2. It's done. I mean, that's the June level essentially. So in the higher time frame, nothing's really changed in the overall plan. You gain 31.7. It's pretty much free skies up to 36K. The problem that we've had overall in higher time frame as well, if I just pop on like typical volume, this is what you're dealing with, right? This is essentially the market. Spot volume was dead there. It died at 27K. It was slow. Actually, it didn't die. It reduced massively the next week going into like the 20th when we hit 28K, stuff like that. So the fact that there's no spot volume on the major exchange, Binance, it should be concerning. If you look at all of your alt tickers on spot, you should see that there's the liquidity on them is absolute dog shit because people aren't buying spot. So what does that mean? Everything's switched to leverage. The priority is we target liquidations intraday, intra-week until that essentially changes. So that's the high time frame. If we do end up breaking structure here, I have some, a lot of interesting levels around 23.1. There's something to say about range gains or losses, about testing the middle of the previous range or the, whatever you tested before. So we'll see what happens if we get down to it. I'm not too worried about it yet. Realistically, we're probably due. If we're actually going to do the downside, I would probably expect something like that. I don't think 20K should hold or would hold. And I don't like having untested structure essentially way, way below us, which this is. So that's the high time frame, and we'll break it down a little bit going lower time frame. Let's see. So overall, Bitcoin, largely boring, just liquidity grabbing as typical we've seen the last couple of weeks. This happened back in the 23rd of August to the 24th, essentially. We take the low liquidity, the longs, right? And then we pop the short liquidity. And it's always 100x to 50x. It's nothing really different from all that. Same thing we did here. We did the move to the upside, grabbed larger liquidity, moved back down and took the 50 to 100x. And from there, we essentially built liquidity, moved to the downside, grabbed the low liquidity again, popped the high liquidity. And that's all there is to it. And this pattern really is typical of what you've seen previously in the structure. So when you're looking at this, for example, what we did here Tuesday, Wednesday, that's not a new pattern, right? Monday, Tuesday, Tuesday, Wednesday. So expect that to be essentially the plan for intra-week if you're going to get that initial drop and take of the high liquidity. And what do you see being targeted? 100x's, 50x's constantly. They build 100x and 50x's for at least a week or two, like they did in the low range here. Then once there's enough downside liquidity, you pop it up to the upside, you take the 20x's and some 10x's. Then you see a swing failure, reversal, back down, grab the high leverage, squeeze, and then repeat the pattern, right? Grab the low liquidity, the longs, wreck the short liquidity to the upside. So that's where we are now. Currently, the structure really hasn't changed too much in the overall. The move back down was kind of predicted. There was a lot of stuff that really looked like it was failing. And then we had the nice failure at the daily open at 26.2. So effectively, I don't really care what happens until we gain 26.1. That's kind of like the demarcation line here. And even then, it's a little less interesting. Alts are definitely the play, or if you're just targeting the intraday liquidity. So if you get these nice flushes out to the downside or upside, only take the trade if you have confirmation of reversal. So we'll go down a little bit on that real quick, and then we'll start doing some indicator stuff. So sorry about the screaming baby, by the way. Okay. Yeah. So anyways, on the 1 hour, again, nothing too crazy. Test the downside, for all the guys who know, right? Swing test, bang. Pretty typical. Still rejecting off the monthly open. If you're using the auto charting tools, the best strategy if you're looking for easy tests intraday are retests of the daily open, the weekly open, potentially even previous daily opens, which you can target those too. So locally, uninteresting, boring, not too interesting, nothing really to say about it. If you want to play this, you go ahead. I'm not looking for it right now until I got a little bit of the short this morning, but that's about it. So looking at ETH, let's see if we got something more interesting. A bit of a stronger wick out structure, I guess you'd call it. And to the downside, we're essentially just grabbing liquidity, very similarly to what Bitcoin's doing. Nice rejections. I usually leave the WO with the 1 there. That's denoting the previous weekly open. And then you'll see significant tests usually with that. And sorry to mute you, bud. Yeah, so 1657, that's the local structure on the 1 hour. On the 4 hour, that's the gain that goes higher. So anything, if you guys remember, for the guys who've been in our group for a long time, 1664, it's an extremely high time frame level. That gain is essentially what you need to take 1.7K back, or at least test stuff. Currently, you're in the low structure. You're essentially splitting the current range and creating new lows. Nothing really looks interesting until you can play the local regain of the weekly open to come back and test the monthly open. So if you're trying to test these levels and you want to get really good at easy trades, the easiest way to say, okay, I want to take manual trades, right? Because that's the best way if you know how to have a strategy, right? Just this is what I do over and over again. I'll just find the level that's interesting. Okay, the weekly open, add an alert to it, and it says, tell me when it's crossing that, essentially, right? So, and then I can do that on all the different charts that I'm looking at. So say, if it goes here, then I want to look at it because there's a potential lower time frame gain to go higher or rejection to go back to the downside. So that's that. Real quick, I'm going to touch on the rest of the market stuff, and then just because we're doing a nice little update, and then we'll go from there. So the dollar currency index as well. Completely breaking out to the upside. We're going to get the close here in about 40 minutes. Pretty good upside structure, still continuing even on the 4 hour. If you're going to look at this thing, really, you got to look at the daily. That's all that matters. We're bullshit back testing stuff. We're getting flush. The back test confirmed that we gained the high. That's all we've done essentially. We're back in the structure that we were doing back in March. This is why most of price has collapsed back to that structure on crypto. If you look at any of the futures prices, you'll see that the wicks of the downside for Bitcoin actually cleared the lows. So that means all of the leverage liquidity has been taken out going back into March. So, the low we were holding from June, like June 15th or mid-June on Bitcoin, that's there's no liquidity underneath it because most of the futures exchanges got wrecked underneath it. So essentially what we look at with this is Dollar currency go up, markets go down. There's a loose but inverse correlation. This thing's pumping really freaking hard. We didn't have the continuation failure. We essentially bounced somewhere around like the major 0.5 to regain structure to go higher. So until we start breaking with this thing, I want to see breaks under like 104.1. Then we can start thinking about a potential retracement. And anything that loses 103 on the dollar currency index, I'm expecting the major downturn. And we should be seeing, a significant pop up in crypto and the general markets. I'll touch on TradFi real quick, and then we'll do the indicator stuff, and then I'll kind of like round trip to like chart requests or TA, question answers, whatever. So higher time frame on the S&P, generally speaking, looking swing fairly. We did lose the low that we did back in July, but not the low that we wanted to hold, which we did. So the S&P technically looks better than the NASDAQ, a higher time frame, just because we didn't do that. And lower time frame as well. It's running a bit flat, still holding structure, still back testing stuff. I have to update my swings, but any loss, further loss of like 44.40, you'd probably see that move back down to like 4.4 pretty quickly. But currently it looks okay. Yeah, on the day it looks decent. And then the NASDAQ higher time frame as well. We pop back up and potentially regain the floor, like the high range, this 15,446 level. But we instantly, we held it, back tested a couple times, failed to achieve, and then failed it and went to the downside lower time frame. So the big thing with the NQ right now is that we actually swept the lows from back in June, which we hadn't done in the S&P. So technically, right now, the entire structure is distributing until we essentially come back up to the highs and actually make a new high. So it's a little bit of a weird one, but that's the distribution structure you look for, because you've lost levels and you lost lows. So the best example of this ever is probably one of the most textbook grabs or distributions you've ever seen on a chart, which, I mean, we all know it, right? It's this. It's what we did back in the beginning of the bull run. This is textbook distribution structure, right? We have upside movement, no major clear losses of level. Yeah, we did back test, but it only filled gaps. Come back to the upside, higher low, higher low, higher low, and higher high, until we made our first lower low. That's the first time we broke the structure. The next one failed to achieve, and by the time we were doing this, it was done. So anything under like 50K there, it was pretty much done. But that is distribution structure, and what you need to break that in the high time trend is if you're making higher highs and higher lows, you make a consecutive lower low and lower high, and that's essentially the confirmation. And that's when it's like, okay, the party's over, the music stopped for a while. So that being said, we'll go into some indicator stuff just because that's what we all want to do. The videos are already up, by the way, on the dashboard for the guys who want a quick little overview, but I'll go into some more technical stuff, especially with things that I like to use and things that I think are super effective for finding levels. So one of the best things that I think still on chart, like regardless of the oscillator, is the on-chain metric bundle, just because you can see all the on-chain stuff without having to have an expensive subscription to like HighBlock or one of these things. It's just not necessary anymore. We actually pull a lot of data from TradingView because they've integrated some on-chain data services. And from that, the best thing that I know is retail stablecoin demand. That's my number one favorite because it updates in real time. I've inverted the chart because I have a lizard brain essentially. I want to see red means overbought and green means oversold. But if I just go back to normal chart just to explain it, it might make it a little bit simpler. So here I am on the 4 hour. The idea with the retail stablecoin demand is essentially the retail traders are fully allocated into cryptocurrency and away from stablecoin when this gets into low periods. Like anything under 25, you're looking for that potential reversal to the downside, essentially, because everyone's getting the free ride. Markets are going up. Everyone's pressing the green button. Oh, we're gaining. Oh, we're going higher, all that jazz. The green levels essentially is when we're dumping. That's usually when there's extremely high retail stablecoin demand. And all that means is everyone is panic selling their alts, their Bitcoin, whatever, back into stablecoin, saying, whew, I'm glad I'm out of that because that was terrifying. And that usually indicates a market bottom. Realistically, this thing automatically adjusts for every low time frame as well. So when you have peaks that hit over essentially 75 or under 25, these denote essential tops and bottoms. You will have some deviation, right? You have some deviation, essentially. So that's the big thing to remember, that you might not catch it right away, but you're essentially looking for that. And if you do start deviating, and I'll just reverse that again because my brain's not going to work that way. There we go. So price going down, the on-chain metric bundle retail stablecoin demand going up. We have deviation essentially where this is actually people are getting more allocated, but price is still going down. You're still looking for that reversal. So it's a good indicator, especially for finding tops and bottoms, especially low time frame. This thing will work all the way down to the 1 minute if you want it to. So at these points, it's actually pretty legit because then you can, if you're a low time frame scalper, which I don't recommend, you can actually do some pretty serious damage when you isolate like range highs as far as like testing. So definitely check it out. I use that in combination with the Harmony Oscillator. So I'll just go on that real quick to explain it a little bit. The big thing, especially lower time frame, the thicker line. This is the trend essentially. Are we trending to the upside? Are we trending to the downside? Are we running flat essentially? The smaller line is going to be denoting strength. Now you can see the first potential changes, and I'll go to the 1 hour so it's a little bit more clear. You can see the first potential changes when we have major moves, when the strength essentially collapses before we hit the high or as we hit the high. So that started coming down as the trend was technically still up. We had the trend break. The trend was broken. The blue dots signify a potential trend change. And then we see the price flushing back to the downside. So even when the thing's fully sold essentially, and it'll bottom out, you start to get the little yellow dots on the little heat bands, from the top and bottom. You're looking for potential long, but at the same time, we almost always focus on price action, which is even if we are super oversold or super overbought, I still want that gain of level, right, to go higher. And until we have confirmation of that, you can have massive deviations in strength and trend, essentially running, from the lows, deviation, and then we run flat and up, essentially. So a good way to use those together that I've always found is just have that extra bit of confluence saying like, okay, what's retail stablecoin demand doing, right? Okay, I've got 3 points of confluence that's saying we're very near a top, essentially. I'm looking for failure. One of my favorite things for failure, if I'm just looking for, to scalp and not trade it, essentially. If I go into core trend, I'll turn this off for a second because I don't need the buy sell signals on it. But the bands themselves are actually really cool because what we've essentially done is we've taken a couple of different standardized indicator bands and we've kind of balanced them to the point where you can have a lot of data from all the different bands on chart at one time. So when you're seeing this area, essentially when it starts getting really, really red, it's volatility moving the upside. You're looking for the failure to essentially go back to the downside. And at the same time, it'll stable off. And even on the first bounce, you can actually counter trade the move down with the first bounce almost always. So even when we get into these squeeze zones, which we are now, we had a bit of a breakout earlier. Very simply, like you have high probability trades that we get bounces back to the upside. Same thing to the upside here, right? What do? We bearishly retested the previous week. We tested the high bands, failed it, came back down. Tested it again, failed, came back down. Back to the low bands, new low essentially established, and that became like the closing zone of everything. So this thing really only changes direction as well when you get closes of the candle on the current time frame. And that's to make sure that it doesn't like automatically adjust and repaint, because you still want those potential closes back within the bands that denote potential trades. And even though this is only a small range, I mean, you can do a lot with 1%. You really can, as long as you're being responsible with your leverage. So those are the two things that I like probably the most if I'm 1 hour and below scalping, just because, or three things, I guess, just to try to find those reversals and have a couple points of confluence. An easy thing to do would be to go back in the chart and use some of the indicator functions off and on. And what I actually did was like write down a list, essentially. So I'd write down a list of the different the different things that I'm looking at. I want to see if something's overbought. I want to see if the retail stablecoin demand is higher than 75. I want to see if we're getting some blue dots for the potential trend change, if the bands are hitting, if we're testing a high time frame level. So essentially about 5 or 6 things. And that's my checklist. Essentially is I can click through to the next chart. I can go on like ETH, USDT. Okay, great. Let's see what that's doing. Right. I'll turn that off so we don't have to see it. And then I do the exact same thing, essentially. Like, what are we doing in the local structure? Are we still holding the lows? Yeah. Was the short from the failure at the daily open? Yeah, we know that in hindsight, right? But the idea being that now I can flip through all of my different charts and just be like, okay, that's the top locally. That's the first pop. That's the top. Bearish retest failure to come back to the downside. You're still in the short because you're not gaining. You're essentially just bouncing on air. And then you get the flush back to the downside. So it's really effective. It works on all time frames, tickers, and whatnot. The one thing I will say is the on-chain metric bundle is very, very tied to Bitcoin. So I would not, if you're trading alts, especially not high caps, I would not use the retail stablecoin demand. That is primarily for Bitcoin, I'd say. So from that, there's a couple other things I like that are pretty interesting, and I'll kind of go through the more detailed ones because they're fun. I'll turn that off real quick. I almost always have the auto charting tools on, just because high time frame opens are a very key part of like all of our trading strategy, essentially. I'll turn the oscillator off. It's not super important. But an interesting one is the multidimensional volume delta. And this one kind of messes with people because it's like, how do I use it? Well, essentially what you're looking for, especially just starting like this, is you have a typical volume profile. If you're not used to a volume profile, it's worth it to Google it just to see how to use it. It's really simple. The low points of volume, price will essentially, you're expected to move very quickly through that. And the reason for that is because price there's no orders there. Or there's orders potentially there, but there's not heavy market congestion. So where we are now at 1631, if we're looking back in the local price structure, because it looks only back to a certain number of bars to look back, we're at the point of control. And that's denoted in the blue line. So the point of control is the highest volume at that price that you could, with the look back you have. And very often, this is the point where you see reversals. This is the point where you see bearish retest, bounce, failure to gain. If you gain it, you're expected to go higher, etc. So with that, it's an extra tool of like, if you want to see, hey, are we at the volume point of control? Or maybe if you go on the 4 hour and then try to see, okay, where's the point of control? Because we have a bit more look back in this period, right? Where's the point of control? Like on this entire structure, we can see it all the way to the back now, which is perfect. So where's the point of control, right? Essentially where we failed. So if I just click that off real quick, where do we fail? We failed at the point of control for volume. We failed to achieve the weekly open. So again, multiple points of essentially confluence. Now, another thing that's interesting is with this is the volume control candles. And what this essentially does is it shows you on bar where the majority of the traded volume is. So the important thing with this is that you want to essentially, let me turn my stuff off so I can draw. What you want to see with, where's my damn thing? There it is. Stuff that's out of position or stuff that's in position. I'll go through that. So here is an example. You have a very bearish 4 hour candle, right? Closes back above. That's the end of the candle there. If you're not also used to watching the market at 4 hour closes, I would recommend that you start doing so because it's extremely important intraday for Bitcoin levels. So here is an example. We have bearish volume that is out of position. What that means is it's a down candle. The majority of the volume on this candle is below where price closed. And because of that, all of this volume to the downside is trapped. These are people who were like, oh, we're dumping. I'm going to smash the red button. So what do? What happens when they close up here? Well, they're out of position. They're stuck. They're underwater. They're holding onto their trades if they're even still in them. And now they're completely essentially the fuel as they get liquidated or close their positions for price to go back to the upside. So when you see 4 hour volume that's out of position, that's a super important place to look for structure and potential reversal. Same thing as we saw here. 4 hour bearish volume out of position, price goes back to the upside, bounces on the swings that I have on the auto charting tool plotted for a larger move up. And all I do with that, for the guys who want to see the swing points, to see these little dots, it filters out the most important by volume highs and lows. And I have it set on candle bodies because that's on the higher time frame. If you're trading lower time frame, you can use the wicks. It's kind of personal preference, but I generally look at it because that's, in my mind, price is coming down. That denotes the high of the swing, because that's the swing to the downside essentially. Same thing as like to the upside. If that's the high of the swing, right above is the low of the swing, and that's a range essentially if you go lower time frame. But that's a whole nother course or another stream, and I'll go into that because that's a fun topic. Other stuff that's pretty interesting is like, you have out of position volume to the upside, and again, it's not going to be perfect. Nothing ever is, but at the same time, is like that's a potential point of reversal. But what did we do? Did we gain above anything? Was there any gain even lower time frame on this structure? No. So even if there's out of position volume, it still has to constitute a gain or loss of level. If you don't have that, then the priority remains with the trend, essentially. And that's how we kind of look at the trend in general, right? The trend is you expect whatever trend the market's in to continue indefinitely until it breaks. That's kind of like our little rule that we look at. So other points you'll see as well here. Here's a good one that we had on the 22nd of August. We actually had bullish volume in control or in position, because the majority of the bullish volume is underneath the close of the candle. So that means essentially that all of this volume here is ready to go. They're not being challenged. That's essentially the bottom of the local move. And then that's a good point to be like, okay, that's in position. So if you're looking at it, like if you want to use MDVD, especially lower time frame, I would say I'm on the spot charts now. I'd recommend that if you're looking at an alt to use this, that is very important that you're using a high liquidity exchange perpetual future, because that'll help you actually see where the volume is. So going from that's the MDVD. There's a couple other cool little things with it. There's the order book. So if the guys who really like the liquidations, I've heard a lot of people are really happy with it because they work. Liquidations are important. That's why you target that stuff intraday and intra-week, especially the high leverage stuff. There's actually a function on the multi-dimensional volume delta that allows you to do that. So I'll go through that. That is the order book. So I'll put the order book on real quick just to show what that means. And what you're essentially doing with this is we're pulling volume data from orders placed. So you can kind of see liquidations, but locally. And that's pretty cool because and we wanted to put it on volume because it's based off of volume. And that's the only way we could really denote it. So essentially, it'll show you like the local liquidations of orders placed. So if we pop up above and we fail, it's because we filled all of the orders. Or if we break the lows, essentially we do one of these, right? Then we come back down. Or if we break to the downside, essentially sweep it and then regain, right? We're regaining structure and we're looking for those failures back in. Those are like our nice little moves with the range. Because that's most of the market, right? Most of the market is ranging. 70% of the time it's ranging. And that's how you can use stuff like effectively to target stuff like, well, hey, we pop the upside, we fail. Where do you want to go? You want to go back to the point of control, like the blue line here. So there's a couple of cool ways to use that. Definitely recommend trying it out. And then the other one was that I want to look at was let's see. Was it? Yeah, the flow index. There you go. So I'll put these away real quick. Because this one's a pretty interesting one, just because it shows you what the priority of the market is in crypto. And what I mean by that is what category or sector of the crypto market that you want to be targeting, essentially with this. And this, the crypto flow index, the on-chain metric bundle, what else? Liquidations and funding rates. Like those four are specifically designed for crypto and not for regular markets. And the other four, multi-dimensional volume delta, core trend auto charting, and the harmony oscillator, they work on every market. So what you're looking at essentially is the green, the large caps, that's Bitcoin and ETH, the altcoins, that's like, your top 10, 20, potentially even top 40 coins and how they're performing overall. And then your shit coins, right? Your anything outside of like the top 150, 200, which you can call shit coins, essentially low caps. So what you're trying to do with this is essentially saying like, well, if blue's stablecoin and we have blue like stablecoin starting to gain levels and go higher at the same time as large caps go lower, that's essentially the look to see, okay, what's the priority of the market? What's going to hold price better? Well, some of the altcoins actually held price better than Bitcoin in this little downside move. The problem is that the entire market was going down and they were just outperforming it. When you have the most effective way to use this tool is that when you're actually pumping on Bitcoin, and then you look at stuff like, okay, Bitcoin's actually coming down, and at the same time this is happening, the altcoins and the shitcoins are moving up. So that'll essentially lets you to target stuff as Bitcoin and ETH are doing big dump moves. That kind of is a pattern that we see over and over again. That before Bitcoin and ETH essentially create a bottom, all of the alts have a potential like little bounce in them, right? So higher time frame is a cool one. You can also target specific sectors. So if you're like, if you like trading AI or DeFi or the different types of coins and tokens, I wouldn't recommend having all of them on. But things that are like clear outliers. So if you just turn, let's say I'll just turn all these off, essentially, except for that and NFT tokens. So like Ape and other stuff. So I'll just have DEXs on and I'll have NFTs on, right? So you'll see wild changes in how they perform against each other. So even here, like we saw as Bitcoin's pumping, DEXs are like underperforming dramatically compared to that, or comparatively NFTs going straight down or not, much lower is effectively than the DEXs. So it's a cool way to target different markets to your advantage. And if you don't like the block structure, like the block line, you can always change that with style. You can just put it on like, the normal line, and it might look a little bit cleaner. That's it's personal preference. I think it was Al already showed us that, which is cool. So yeah, it just looks a little bit cleaner if you're into that thing. So definitely check it out. It's an interesting one. We're working on something that we can do with specifically targeting tokens, but we'll kind of go from there. So those are those two things. Generally speaking, about the strategy stuff. Let me see if I have my. Try to see which chart I have it on real quick. No. A million of these things. No. I think I might have it on the BitMEX. No. No. That's all right. I'll just write it again. It's not a big deal. So yeah, I'll be on the index here and I'll just kind of type them out. So this is just kind of like my rules as far as trading, and you guys do what works for you essentially. But this kind of section, I just kind of want to talk about like what general strategy is, right? Like how do you allocate capital? So these are kind of like the rules that I follow because I don't want to break this because this is what works for me. So first off, number one, never more than 2% of my capital committed. So what that means is that if I have $100 or $1,000, right? Let's say 1,000, $20 of that is the maximum that I'm willing to commit or lose in a trade, right? And you can do those calculations pretty quickly. You can use the trade calculator on whatever exchange you're using. What that means is if I'm taking a position, the maximum I'm prepared to allocate and potentially lose is 2%. Like I'll never cross leverage my account, my main account, right? There's no point to it. That's an absurd thing to do with a main account because it eventually can go against you. There's all types of problems that can happen. You can get skipped in the order book. You can essentially lose connection. The exchange could essentially just have a data error, something like that. There's all types of horrible things that can happen. So that's capital protection. That's capital preservation at all costs. And the next one, I've kind of revised it a bit, but I've kind of changed it. 4-to-1 risk reward or higher to first profit target. I used to say 3-to-1, especially on when we had a lot more liquidity in the market. The problem is now the market is effectively is just going liquidity to liquidity, and I would rather not. I'd rather have a high risk reward ratio or reward to risk. I guess I should reword that. Jesus. So What I mean by that is if you take your handy dandy little long short position and say, well, let's say if we gain the weekly open, I'm looking to target the high of the current move of the daily open as my initial profit target. And I want to make sure that my risk reward is no less than 4. So what that essentially means is that I'm willing to make 4 for every 1 that I lose. And the reason this is important, and this is kind of like a weird one, most people don't win most of their trades. And you don't actually have to win 50% of your trades to be profitable. And I know that sounds crazy because everyone's like, oh, what's the win rate? I want the win rate. Win rate needs to be high. Win rate has nothing to do with profit. And that's a weird one for a lot of people. And I understand that, but I'll explain it. So what you should be targeting is your profit factor towards your drawdown. So how much profit you're making over how much money you're losing over time. Because if your win rate's 90% and you're like, woo, I'm winning 9 out of 10 trades, but maybe you win $1 on every one of those trades. And then on the 10th trade, you lose $9, right? You're essentially zero. You haven't gained anything back. And one of the best ways to effectively defeat that is, well, let's say price goes and gains the level. Like, yay, entered, we're going good. Oh, just goes against me. We go back down to test maybe this swing or something. Now, most people would then say, oh, well, that trade's invalidated because it stopped me out, and then they'll move on to the next thing. The problem is that where your stop loss is and where the invalidation of the trade is are not necessarily the same thing. So what I mean is that if you have a 4-to-1 risk reward on a trade, you can enter that 3 times. You can take the same trade because you're still targeting the same level, and you can make profit on it. And that's why we do high risk reward ratio. Because you don't need to win half your trades. You just need high risk reward. You need capital protection. So yeah, the next one, and this is, I'll just keep it like these 3 is kind of like the main ones essentially. But once your profit target is hit, like your initial one, move your stop loss into profit. Now, I know some people that do stop loss or second profit target. I do that sometimes too, depending on the time frame I'm trading. But the idea is that the faster you move your stop loss into profit, right? Like, okay, we're hitting the first profit target, bang, I took maybe 20, 25% of my position off because you pay yourself. And I'll just write that in because that's an important one as well. So the point with that is that you should pay yourself for taking good positions. You don't need to be market smashing in and out of positions just because, oh, I want to make sure, I want to wait until I hit a 2x on this trade. Like that's not a smart way to trade. You're looking to plan your trades out to say, I want to take, that's my initial profit target, and then that's my second one, and that's my third one, and maybe I'm taking an aggressive one because it's a pretty big move on the 4 hour. I'll take half my position off. I'll take another 15% there, and then 15 there, and then I'll just let it run in case we go up. So I have some type of allocation. So with that, the idea being of moving your stop loss into profit is once that is hit, my stop loss, which is down here, now goes above my entry. Now, the reason for that is because you never want to put if you're trying to stay in profit and not get stopped out and lose, if your stop loss, which should always be a market order, right? You don't want to ever limit a stop loss unless you're staggering stop losses out, but that's a more advanced thing. Your stop loss needs to be the ejection button. It's the red button that says, get me the hell out of here before I lose all my money. And if the price is dumping against you, like hard, understand that the way order books work is that it doesn't matter the size of your trade. If the size of your trade is $10 and there's a $5 million order in front of you, and they're in front of you, like they've been placed before you, they're going to be filled before you are. So that's just to protect against slippage. That's protect against it just going like straight down and stopping out regardless. So stop loss and profit, especially on futures, is a requirement for me. And then there's a couple more things I go through, but that's the essential thing that I do that works for me, right? So when I plan my trades, essentially the rule is that it has to meet all of my conditions. It has to make sure that I can actually hit a 4-to-1 and it's reasonable. It's not an absurd movement. It's got to be, the entries have to be based on a gain of level, like an important structure. And I can base that off a lot of things, right? I can use my liquidation levels to say, well, if we gain that, like I'll market smash an entry to go higher. And you can do that with what on your exchange, which is essentially called like a stop order. So I don't want to enter the position until we get to that point, because then price is just going to go. So you can do those type of things, but I like back tests. I like things, price comes down, creates a new low, test the level that we want to test, break down, secondary failure, move to the downside. That's the way my brain works with price action, is that I like gain or loss of level. I like things that retest. And when we actually create structure higher, that's when I get excited, because bullish retests of level mean that we have a potential to go higher. Just like here, right? Earlier today, right? If we would have held 26K, 26.1, that would have been a potential long to actually have a continuation move higher. Why? Because we'd essentially be, the local low, the higher low, and the higher high that broke previous structure. And it broke 3 highs to the left of you, right? So what are you doing technically, as long as you're holding the previous major low? You're technically trending to the upside. So you're still looking for that potential continuation. Not so right now, or at least I'm not, because price is dumping and going against you. But there's still the possibility of a gain to go back higher, especially when we have a nice big liquidity pocket above you. You should be targeting liquidity. And this is a weird one for some people, but I generally don't enter positions on these liquidity levels unless I'm trading really low time frame. And the reason for that is because these liquidation levels, or these liquidity points, are great levels to take profit. You will always get filled unless you're trading absurdly high quantity value trades. So, if you're in the shorts from these things, you take the profit in liquidity. It's the same way that if you're a market maker, a whale, you look at liquidation levels, because they can buy data directly from exchanges, and you look at those liquidation levels, as points that you would want to fill your orders. Now, there's a lot of other stuff that goes into market making, how they restrict stuff, and they use essentially different exchanges and different accounts to restrict order, and there's organized guys. But Bitcoin's not like it used to be. It's not like it's 2017 anymore, and 2018, and that whole bear market. It's not like a couple guys. You can market smash a couple $1 million order and it'll dump price quite significantly. Like it doesn't happen anymore. The market's too liquid. But they can restrict stuff really locally, and they can hold things, and they can fill orders in liquidity. Because to fill large orders, they need people to get liquidated. When people here essentially are getting exited out of the market at the highs, let's say they're, you shorted this, smart, but you didn't take all your profit, and then price went against you, and you got liquidated. Let's say your value of your trade is $100. Well, the only way to exit a position, so if you're in a $100 short, you essentially, that's the contract you took. You're in a short. The market effect of you hitting, $100 short says, oh yeah, price effect towards the liquidity going down 100. When you get stopped out or liquidated to the upside, what happens? What has to happen to your order for you to get out of it? You have to essentially, the market effect is you have to buy 100. And that's how you get liquidations, like these kind of very strong upside moves, right? Strong upside moves, strong downside moves, cascading liquidations when we have people essentially, the ripple effect of all of the longs essentially getting taken out, because the market effect of these people who are in positions, you're talking about hundreds of millions of Bitcoin that now are technically market selling to exit their long positions, which just nukes price to the next level. And then the same thing happens, market selling, because they're in longs, right? So in that dump, as an example, like there was at least $1 billion wiped out from futures, and 800 million of that was from longs. So yeah, when you're looking at liquidations, lower time frame, that's a great way to plan trades. 4 hours, the golden hour for the people who don't know. Like if the 4 hour basically tells you everything you need to know. You can see the lower time frame tests of structure, the stuff that's important, and at the same time, you can also see the lower time frame stuff. You can flip to it really quickly. So it's like, for me, it's that perfect kind of like middle ground of seeing the high time frame, the low time frame, and you'll see it very often that 4 hour closes, especially in crypto, are very key to the price action structure. Like more so than a lot of other stuff. So in general, when I look at this and I plan my trade, all the conditions are met. I have my little checklist I talked about before, using the different indicators that says, okay, we're super overbought or super oversold, and we're failing structure, we're losing levels, we've grabbed liquidity to the upside. All those checklists are great. If I enter the trade there, I'm instantly placing stop losses. I'm not ever going to have an open order or an open position that doesn't have a stop loss. That's how you lose money. And then from there, essentially, if I'm looking to take a trade, right? If I want to say the gain of 26.2, doing that is the move that goes back to take liquidity. That's my expectation, my assumption. So what I do then is I plan my trade. I put a horizontal line there. Essentially, I say add an alert to it. So when it's crossing that horizontal ray, I want to get an alert that says, hey, it's potential trade zone. And then I measure out my short rate or my long position trade plan to like the first big pocket of liquidity. Get some high leverage stuff there. And then it's good risk reward, but it can go against me a little bit. So let's see if that works. Nope, it's too low. So somewhere around there, right? I'm okay with that. Coming down a little bit. And then you just look lower time frame if it holds water. If we gain that, right? Gain that first little structure spot. Yeah, it would probably work out okay. So not too worried about it. Daily open, bullish back test, not sweeping the lows. Okay, pretty good risk reward, pretty good probability if everything's lining up. And that's how you plan the trade, essentially. And then biggest thing, if you plan the trade the plan. Don't start getting, don't listen to the good idea fairy that says, if you just wait until it goes there, you'll make this amount of money. People very wrongly use the ruler when they're in position, like, oh, if it goes there, I'll make this much. Or if it goes to 5%, I'll make $2,000 or whatever. That is not the way to use the ruler. If you're going to use the ruler effectively, you're looking at higher time frame changes in percentage. Or if you understand liquidity and liquidations, you're saying like, oh, well, from the daily open, where was the 100x liquidation level at? It was probably there. Where was the 50x liquidation level? Probably there. Where was the 25x liquidation levels? Probably somewhere around. They probably still have some in place, and that would probably take us down around there ish. So that type of stuff, which is a bit more advanced, but you'll get the hang of it after the more we do these kind of fireside sessions. So that's a little bit of like how I trade, the stuff I use that kind of helps me out. Like I said, core trend. Even if you're just using the bands, which is really simple, you can just turn off the manual mode, which will show you the bar or the scalp structure, and then I'll just go down here to the bands type, and I'll use the Trendmaster bands because it balances everything. And all I'm doing is, we're starting to get very, very overbought. We're having reversals on harmony, like the strength is breaking. Trend change happens here, and we bounce off the upper band. So you get 4 or 5 things going for you, essentially saying like, yeah, we're probably reversing, and we have the daily open, so we're failing the level. Where's the target? Back to the downside. So, and then rinse and repeat and do it over and over and over again. But so yeah, that's kind of what I want to go through there. I'll kind of open it up now for people who have questions about indicator use, or if you have chart requests, since we haven't done a market update in over a week now. So if you guys got anything, just feel free, say what's up or pop it in the chat. Let's see if I can see this. Any questions there? All good. Nothing. Everybody's just mind blown. Is that the expectation? All Gucci. But yeah, so if you get any questions, like I said, if you got charts you want to look at, chart requests, or any questions about using the indicator, anything that you're interested in, essentially, I got some time, so throw it at me. And like I said, like these rules, they don't have to be your rules. But what I do recommend is having at least a 3-to-1. I preferably like 4-to-1 or higher. Make sure you're planning your trades to your first profit target. make sure you're taking aggressive profits. Like, don't just market smash in and out. Like, you can do it. It's just an inefficient way to trade. It's better to like enter and then, start actually taking profits off because you're making a good decision. Plus, the more you do that and the more you get comfortable doing it, the more likely it is that you'll build high time frame hedges. So if you're in like a high time frame range and you actually can start building a long and building a short, and you're perfectly hedged in the entire friggin' range, like you're literally guaranteed to make money. And that's the entire point. Like if you look at like the leaderboard, I think it was on like FTX before that all went down. There were guys on there who were back in the summer of 21. There was one dude, was it John Brown? Some dude who was down like $500 million or something against a position. And and he held it and then it went back up and he made money. Like crazy stuff. Let me just check the thing. Yeah, it was John on Fin. It was Finex. That's right. Yeah, it was minus 300 mil. Thank you. Thanks. So yeah, we'll look at a couple different things. Just pop in the chat. I'll leave that up there for now. Baba. Oh, you're looking at some stonks. Stonks, dude. All right. What do we got? Baba, we had a major loss of the yearly open. That's not looking great. And that's just from the open today. If you see anything now, you'd want to see some kind of bullshit retest of that structure. You only got 30 minutes left before the end of the market, it looks like. So I'm not expecting too much. The only thing that would matter to me was regaining like 91. If we regain 91.20, the yearly open, that's the only thing that matters. Even higher time frame, I don't think there's anything else. Yeah, higher time frame, you need to regain the yearly open. Until then, you're seeing downside pressure. Technically, still a higher low from what you did previously. But local structure just looks really nasty. I think that swing is done. So pop that sucker over Shaw and see what happens. Okay. Yeah, gain the yearly open, and I would probably say you're good to target March and potentially September. You got some levels up here. Like that looks pretty interesting. Anything else? Taking profit is important because of its positive psychological effect. Yes, NLP. That is Dutch Pete. That is 100% true. That is a very good point. Taking profit reinforces the positive psychological part of your brain that says, yeah, I did good. That's important. Very good stuff. Getting off in small amounts out of the market feels better than a big one only once. Yep. And that's a weird one for a lot of people, man. Like unless you've been trading for a long time and you have a system that works and you're just trying to improve it and optimize it, which is awesome. Essentially, a lot of people will go through either two things. They haven't been punished in the market, or they've been punished and it's broken their brain a little bit. The people who haven't been punished essentially in the market, haven't been like wiped and liquidated. Don't like learn from mistakes. I've been liquidated. I'm sure Max has been liquidated. I'm sure I know Will's been liquidated. Like we've all major good traders that I know today, you have to get liquidated because it basically, there's two types of people. It's like, you basically just get like sucker punched in the mouth by like some bodybuilders, like 300 pounds. And that's what it feels like. And then you pick yourself up and you build yourself back up after it. And that psychological effect, a lot of people like literally it hurts them like a loss, like a if you lost like a significant other or something. So a good way that I've found as far as getting back from that is to trade, but trade with the lowest amount possible, doing good TA, taking good positions, using price action to your advantage, making sure you're planning your trades and you're planning your trades and trading your plan essentially. And when you're reinforcing like good habits and you're making like small amounts of money, you're building back that thing in your head, which is two-part, which is I'm okay, I'm doing good. And at the same time, even if you have small losses, you stop caring about it. Or even if you have losses in general, it's like it doesn't bother you. So you're kind of like exposing yourself without really financially damaging yourself. So it actually helps you get better as a trader because now, as you build up, you don't focus on, oh, that's $50 or $100, because the moment you take the amount of money you have and then you start comparing it to like, oh, but if I get, if I get 100K, then Lambo, like you think about your account size in terms of percentage, like whether you're trading on $100 account size or, a couple 100K, your idea of your account size should be based off a percentage. Like, I'm not willing to risk losing more than 2%. I'm not willing to allocate more than 2%. So very good point, sir. Thank you. Mike C. When you get liquidated, ask why you did, note it down, learn from the mistake. Yep. Keeping a trade journal is essential, especially when you make mistakes. It's like if anybody likes to shoot recreational or something, it's like a shot book. You learn only from your mistakes. Mistakes can turn to wins if you know where you went wrong. Yeah, that's it. A lot of people just get punished and they don't know what to do and their brain goes frazzled instead of like, digging through the corpse of your trade, which isn't the worst case, and figure out what you did wrong. 100%. +1 for journaling, especially in the first few years. Yep. It's a lot more work than people put it out to be. I mean, it really is. I mean, it takes a long time to where you can just kind of like look at a chart and be, okay, it's doing this because of this. Or it's like, okay, that's a good trade if we take that. That's a good, I could see a 4-to-1 risk reward to here, blah, blah, blah. Like, yeah, it takes time. And I'm not going to pretend like I'm a master trader or anything like that. Like, I know what I'm doing and I make money off of it. The problem is that if you're not reinforcing good habits and like doing the hard legwork at the beginning, or even after, even if you're intermediate or advanced, like it's always good to have a session where you kind of come back around and be like, okay, well, let's get back into journaling. Let's make sure I'm, keeping back up with stuff. Maybe look to optimize and make more efficient your trades, like 100%. That is essentially the key to everything. Is just improvement. Once you've got like a good base build, a good foundation, then you make it look pretty. Then you build a house on it. Dang, we actually got a couple people in here. That's nice. Yeah. Any last things? Charts or TA questions or anything in general? Speak now, forever hold it. At least until the next one. Nope, all good.
Render.
On which one?
A render.
Render. Yes, I can look at render. Okay, render's in an awesome range right now. It's holding some good structure. Any gains that probably take you about 1.5 or higher, that's the gain that takes you back up to test structure at like 1.6. You've variously retested all the structure here. There's nothing left to do. So even on the 4 hour, you're looking at like 1.57 if you gain 1.5. Locally, that's the range high, and probably liquidations. Yeah. Let me just turn that off so we can see it. So yeah, you grabbed all the liquidity perfectly, all the 10x longs or 10x shorts from all the low structure. It's all taken out. So where's the next liquidity pocket since you're so far away? Look at it this way, right? You have to go up about 10 cents essentially to get it back into liquidity essentially. To the downside, all you really need to do is like, you've got some 50x shorts from today that are longs from today that are still in place below you. And then if you do start breaking down and, with that already being tested at 1.4, essentially 1.396, if you start losing that level, where's the slide? Like, where's the liquidity slide? All right. If the more you use liquidations and looking on the chart, you'll actually start seeing it too. Because like, hey, we actually just kind of like crabbed up and didn't wreck any lows on the way up. So where's the big long liquidity? And that's high leverage too. That's still in place, and all the stuff below it, which is definitely still in place. So that's the way I play it. You're probably coming back down. You're looking like you're at the range high where you hit it earlier today, right? You had the failures. You tested the weekly resistance structure. You perfectly tested the daily structure. Failed the daily open. You're back underneath the March. You're holding some kind of middling structure, which isn't that pretty. It's not super attractive locally, but the gain of this structure is what takes you higher. Because what do we know from this? It's fully tested. There's nothing left to test. So if it does gain, you'd want that continuation higher. But currently, I'd probably still eye lower until we start gaining something locally, just because you're at the range high, essentially. If that makes sense.
Yeah, thanks. We are on the same page.
Yeah. I mean,
exactly.
No problemo. Anything else? TA tickers, all the jazz. I think fundamentally too, just we always touch on it, is that fundamentally render has some extreme upside potential as long as it can hold the local structure. It looks a little bit rough, higher time frame, just because it's got that big gap. But even on the weekly, like you've already tested it. Like for the guys who remember back in March, we took this one pretty easily because it's a range gain, right?
Yep.
I need to. Boom. There we go. So there you go. That's essentially the range high structure. So you're still in the upside range, which is good. And I think Will probably knows a lot more about this project fundamentally because he actually has used it too. But they outsource, or it's like, what is it? Outsourcing, rendering, 3D modeling, video, all that stuff.
Rendering.
Yeah, cloud rendering. There you go. So really cool stuff. I think this one will perform very well because it also has a very high use case, unlike other projects that are really big, like I don't know, like Cardano. Which played out perfectly. The short. Yeah, I know. A lot of people are like, Cardano to the moon, it's going to $1. It's like, probably will. No, I probably will. Charles Hoskinson, man, he's a talented hype man. He's got like the cool nerd style hype man. But yeah, it looks pretty freaking shit right now. Higher time frame. There's nothing really impressive. Outside of it holding like the local floor structure, so like that essentially. And even that doesn't look too pretty. Yeah, that looks pretty nasty, if I'm not gonna lie. There's a nice gain of 2556 to take you back up the daily open, 2586. Just to retest structure on like the 4 hour. But this is like 2019 all over again. It's just low liquidity on spot. It's dead. Like, you really got to be looking at like the perps because liquidity on spot right now is just trash across the board. See if there's any more questions. No, that's it. Well, I guess I'm going to wrap up then, guys. That's pretty much it for me. I guess finishing on Bitcoin. Hope you caught the little short from today. That was fun from this morning. Other than that, not a whole lot left to say. Hope you enjoy the indicators, test stuff out. I'd love to run like maybe a promotion or if possible, like to see who could find like good combination strategies and stuff, and we can vote on them. I think that'd be a fun thing, but we'll see. We'll see what we can do. It's going to the weekend, guys. Hey, you're welcome, man. Yeah, so we're going to the weekends. Just remember, liquidity is not your friend of the weekends. But expect Bitcoin to run flat unless it's an outlying weekend. Most weekend structure is bad. If there's a CME gap from Monday, you can target it from the open if you're one of those like night owls or at 0 UTC essentially. Let me just do a little check to see if there's an update on the CME report. No, not yet. But yeah, that's it. If you're going to play the weekends and Bitcoin goes sideways, one thing that I always like to do is keep an eye on Bitcoin dominance. So if Bitcoin dominance has a continuation failure, which it did earlier today, we'd like to see dominance keep dumping and Bitcoin price hold. If that's the case, then we'd probably see alts do a little bit of upside move. And that's been kind of typical for the weekends for a couple of months now is, alts will do something fun over the weekend. But as far as that's concerned, I'm going to paint my house and chill a little bit. So thanks. Yeah, thanks, Meek. Thanks, NLP. Appreciate it. Hope you guys could learn something. And I'll set up the fireside for next week. So peace out.
Awesome. Thank you.